hope everybody is having a great October day. This is my favorite time of the year. So, number one, we've got the mosquito population that is starting to decline, which is great. Number two, it is my birthday month, which is always a celebration. And number three, who doesn't like fall, right? Obviously, it's that sweatshirt weather and so forth. But we're not here to talk about the seasons. We're not here to talk about fall. We're here to talk about market volatility, right? And we have seen a tremendous amount of volatility really creep into the economy in 2022, right? So we've had a really nice run the last 5-10 year period. We had the pandemic come into full circle in 2020, which created a lot of uncertainty. 2021, we had a fantastic year of growth. And here we are in 2022, and it's created just this high level of uncertainty, which creates a lot of stress for clients, ourselves, et cetera. So what I wanted to do is just take a moment, right? We're going to go through our agenda here in a second, but ultimately I've got a presentation put together, and the presentation should last somewhere between 20 to 25 minutes. And at the end, this is a live webinar. So if you have questions, I want to make it very interactive, and I want to make sure that your questions get answered, right? Because if you have the question, someone else on this webinar probably also has a similar question to that. So on the bottom of your screen, you'll see a Q&A spot, and you can click that, and you can actually type a message directly to myself and our team. They'll get it forwarded over to me, and ultimately that will allow us to get that answered. So I will go through our presentation portion. That'll be the first 20 to 25 minutes, and then we'll take as much time as necessary at the end within reason. Obviously, we're not going to go for 4 or 5 hours, right? But with reason, we'll get your questions answered as quickly as possible. So with that, let's get started here. So I want to cover the agenda for today. So when we look at the markets, I really want to break it down into 4 steps. Number one, what's going on right now? And this is a question that we're getting. I reached out to many clients just over the last 2-week period. And as I'm talking to them, the number one question is just what's going on, right? They want a better understanding. I'm a big picture planner. So typically I'm talking at a macro scale. Today, I'm going to dive in and get much more finite because my goal is to educate all of you. I want you to have a very clear understanding of some of the pieces that we're watching, because the best way to overcome fear is through education, right? What we're going to do then is we're going to look at where we are right now in the markets, right? What do you need to be paying attention to? And I'll actually give you a few real life examples of things you can walk away here with and check, right? We're going to look ahead. We're going to take some time and look ahead at different factors that we need to pay attention to with all this volatility. And then fourth and foremost, right? How do we make sure that you're continuing to be successful through this market? So those are the 4 pieces that we're going to touch on. And with that, let's get started. So number one, what's going on? The 4 things that I'm going to touch on here: high inflation, right? All of you are seeing inflation to some capacity, right? Inflation's been creeping up even starting into last year. And here we are in 2022, we're at the highest level of inflation since the 70s, right? With inflation typically comes increasing interest rates, right? That's the ammunition for the Federal Reserve to hedge inflation or decrease it. We're going to talk about that. The value of the dollar is ever increasing, right? It's been going up, up, up. And that sounds like a good thing. And sometimes it is, and sometimes it's not. And then ultimately, right, world unrest. We're seeing a lot of just political issues internally, but we're also seeing a lot of unrest with, conflict breaking out between Russia and Ukraine. You hear Taiwan in the news, et cetera. We'll touch a little bit on that as well. So they'd be the 4 big talking points on what's occurring right now in the overall economy. So let's get started here. High inflation, right? When we sit across from a client, inflation is just the cost of goods or services increasing year over year, right? It's your livelihood, your expenses are going up, and it becomes a huge nuisance, not only to the economy, but to the average consumer, right? So if you look at it, they measure inflation through what's called a CPI report, Consumer Price Index. And you can see on the left side of the screen, year over year, so the past 12 months, we've seen the CPI, or the Consumer Price Index, increase by 8.3%. So in layman's terms, what that means is things are 8.3% more expensive than they were a year ago. And niche sectors, right? Specific sectors are up more than others, right? Energy prices are through the roof, right? There was a period of time gas prices were through the roof, right? Food, if you go to the grocery store, it might be up by 20 or 30% in expense compared to where it was a year ago. But overall, the average expense is up about 8.3% year over year. And if you look at that chart, the chart dates back all the way to the 90s. We have been through a very low period the last decade of inflation. And as consumers, we've gotten used to that. Interest rates have been extremely low to stimulate the economy. And on top of that, inflation's been very low. And now we're starting to see a very dramatic spike in that expense. So most people understand what inflation is, but they don't necessarily understand what caused it. And I put some bullet points here that I'm going to talk through, but realistically, from a macro level, from a 30,000-foot view, right, we infused over the last 2 years in particular in a huge amount of economic aid. So there's what's called quantitative easing, and quantitative easing was a tool that the Federal Reserve used after the last recession, after 2007, 2008. And what they were doing is they were infusing money into the economy. But it's interesting, only about a third of the money that they infused into the economy actually landed into consumers' hands. Most of it landed into the hands of the Federal Reserve to back up their reserves, right? So there wasn't near the amount of assets that actually landed with consumers. During the pandemic, right, interest rates were cut. The federal funds rate was literally at zero. They couldn't go any lower. So that meant that ultimately people could get credit at a very low interest rate, which made it more inexpensive, right? You had more cash flow. People also weren't doing as much during the pandemic. And we had stimulus checks, we had forbearance on student loans, we had the child tax credit, which, the last 6 months of last year, if you had a child and you were under a certain income threshold, you got $300 per month per child, right? You add on top of that forbearance of student loans, that might have saved you another $500. So people were freeing up cash flow that they didn't otherwise have in years prior. You add on top of that a term called pent-up demand. People wanted to do things, right? For gosh sakes, you're locked in your house for a year and a half because of a pandemic that nobody could see coming. And then ultimately, you want to go on vacation. You want to buy things. You want to do things that you weren't able to have. So anytime that you have this high demand to go places and spend money, right? And you have a clog in the supply chain. And COVID was a huge clog in the supply chain, right? Right now, the United States is underemployed. We don't have enough employees to even be in the retail warehouses to get onto trucks to drive the product from point A to point B. China, which is one of our main importers, right? We import a lot of product from China, had a zero COVID policy. A lot of their ports were shut down. So we couldn't get the darn product here fast enough. And that's why when you went to the stores, you saw empty shelves. Or when you went to a car dealership, you saw empty lots, right? You saw 3 or 4 cars. You don't get to negotiate. It's just you buy what you can get. So anytime, just going back to supply and demand, anytime people have a high demand or desire to buy things and there's a low supply of inventory, the remaining product goes up in cost. And that's what we were seeing with inflation, right? Ultimately, we couldn't get the product here. There was a limited inventory and still is in certain sectors, right? And we had a high demand to spend money and do things because the economy was doing quite well and people had extra cash flow, right? So that's where inflation started to take off and continue to go up, up, up. Going back to the, quantitative easing versus stimulus, as I said before, to stimulate the economy after 2007, 2008, the Federal Reserve utilized quantitative easing. This time they basically utilized stimulus checks or stimulus money. And what we found is of the approximately $4 trillion they infused into the economy over the last 2 years, instead of only a third hitting the consumer, almost 85% of that stimulus hit the consumer's pocket. which means we put that much money into the hands of the consumer and they started spending, and we had low interest rates on top of it, and inflation is running wild. So when you see high inflation, right, inflation is an indication that the economy is overheating. I want you guys to write that down. Okay. Inflation is an indication that the economy is overheating. It means people have a desire to spend money and there's not enough inventory to catch back up. So what the Federal Reserve does to hedge that is they increase interest rates. And that's what you hear in the news all the time. They're increasing interest rates. And most people are saying, well, I don't really know what that means other than rates have been really low and I've gotten little to no money on my checking or savings these past few years, right? So interest rates increasing historically decreases inflation. Okay. When interest rates go up, in a nutshell, what the Federal Reserve is doing is making things more expensive to decrease your desire to buy the product because you have less money left over at the end of the month. So let me put that in a little more straightforward terms. Going back to supply and demand, okay? We just talked about how people have this huge desire to spend money, go places and do things, and interest rates are cheap right now, or were cheap a year ago. And ultimately, the supply chain couldn't keep up. When they raise interest rates, when the Federal Reserve raises interest rates, what they're doing is increasing the federal fund rate. They're making it go higher. So that means that if you have credit card debt, you're paying more interest on that credit card. If you want to buy a new home, mortgage rates will be higher. We've seen that, right? So mortgage rates a year ago were approximately 3% on a 30-year fixed mortgage. Right now, they're close to 7%. Right? If you wanted to buy a car, I have a client, he's got perfect credit. Literally, he's in the mid 800s on credit. He's paying 7% on his new truck, right? A year ago, he probably would have gotten 0% financing. So they're increasing the interest that's being charged by the institutions to make things more expensive, because if you're paying more interest, you have less cash flow left over each month to buy goods. So your desire to buy product goes down and the supply chain can catch back up, right? That's from a supply and demand standpoint. The other piece that nobody's really talking about is what they call cash versus credit in the economy. And when I heard these numbers, quite frankly, and I'm a big nerd, right? So I hear numbers and I get like, whoa, I get excited. When I heard these numbers, I couldn't even believe it at first, okay? In the US economy, right now in circulation, there's about $2 trillion that goes to the economy. 2 trillion, okay? That's the circulating cash in the US economy. So 2 trillion, that means that people, when they're measuring GDP, gross domestic product, or measuring the growth of an economy, they're saying of that spend, of the economy, 2 trillion is represented by cash exchanging hands. 90 trillion, 90, so 50 times, is represented by credit. So think about that. 2 trillion of the exchanges that happen that measure the GDP are through cash. 90 trillion occurs through the exchange of credit. So when we look at that, that means that people are using credit to buy things because interest rates were really cheap. Right? You're more apt to go buy a new home if you have to pay 2% interest, right? Versus 8% interest. You're more apt to buy a car if you have 0% interest versus 7% interest, right? So the society that we have utilizes credit to generate value, generate wealth, and exchange money, right? If you go to a restaurant, typically people are using their credit card and paying it off at the end of the month. So credit is exchanged as a form of cash versus cash itself. So when the Federal Reserve increases interest rates, what they're doing in a nutshell is by increasing rates, right? Credit becomes more expensive and it decreases the purchasing power for the consumer, right? By decreasing that, ultimately what they're doing, or if they were to decrease rates, right? If the economy was struggling, you would drop rates lower because it makes things cheaper and it puts more money in your pocket. So what they're doing by increasing interest rates right now is they're making it more expensive, right? And they're decreasing the amount you can purchase with that same credit or same money on a monthly basis. So let's think of a house, for example, right? If you wanted to purchase a home, just grabbing my time value of money calculator here, let's say that you purchased a $400,000 home, okay? Or let's say that you took a loan out for $400,000. So a $400,000 home, let's say at a 3% interest rate, and it's financed over a 30-year time period. Your principal and interest payment on a monthly basis, and I'd show you, but you can't read it, is $1,686 a month. So if you bought last year a $400,000 home and you got a 3% interest rate for a 30-year time period, your monthly payment would be $1,686. Today, since the Federal Reserve has started to increase interest rates, remember, they're making credit more expensive, so you use less of it. So ultimately, a $400,000 loan at 7% interest, that same payment just went from $1,668 per month to $2,661. It costs you $1,000 a month more than it did a year ago because you're paying more for that credit. So typically what that means is you can afford less house, and the demand for those homes comes down, you have more supply, and it starts to regulate the inflation. So long story short, interest rates going up historically reduces inflation over time. Third thing I want to talk about is just the value of the US dollar is going up, and it's going up, and it's going up, and it's going up, right? So this is a double-edged sword. You hear that and you say, well, that's a good thing, right? Well, it's a good thing for domestic inflation, for inflation inside of the United States. So if the dollar is worth more money, if we're importing products and buying things from other countries, that means that it costs us less dollars versus their currency to purchase that product. That's a good thing for domestic or US inflation, okay? But what's bad is it's basically passing along an inflation to global economies. So you think about it, if the value of the dollar goes up, and let's say that you're a United States company, you're a company based in the United States, and you're selling a product to another country, it now costs that country or company in, let's say, Ireland or wherever the company is located, more of their currency to buy that same product. So what we just did is exchange our inflation here to their country there. And now the inflation starts to spread globally. And what happens is those companies or countries are able to afford less of our United States products because it costs them more money. So it's a double-edged sword because now we're in a global economy. It's no longer just the United States, just China, just Russia, just these different players. We're in a global economy. And as the dollar continues to increase because we're raising interest rates, that means we're making our products here in the United States more expensive for other countries and companies across the world to purchase. So it is something we are paying very close attention to. World unrest, right? This is the fourth and final piece before we start looking at some of the real life examples and getting some positivity going here, right? It's not all gloom and doom. So world unrest, right? There is a lot of serious stuff that's occurring right now. Right? So just outside the United States, you look at Russia and Ukraine. One of the big factors that has occurred, other than the bloodshed and so forth, right, is ultimately we've seen a huge spike in energy prices. So what's happened is, remember, I talked about a global economy. We're all interconnected. So gas prices spiked extremely high earlier this year. And I'll show you on a chart here in just a few clicks on how that impacted the overall markets. But ultimately, gas spiked through the roof because Russia is a large producer of oil, and ultimately, Ukraine is a large producer of food and other energies. So when you look at that, if they're in the middle of a conflict, right, they're not producing or exporting the same amount of food or the same amount of energy that they were before. And what that does is it goes back to supply and demand. It creates a world shortage of energy or a world shortage of food. That means other countries and players have to pick that up, but there is still a high demand to buy it. but there's a limited availability of that product, so people have to pay more money to get it. Right. And that's what we saw with ultimate gas prices. That's what we're seeing with food in the grocery store, and why we're seeing shortages in certain areas. You hear Taiwan in the news with China, right? So it's just more unrest that's out there. And it's things that we just have to continue to pay attention to, but ultimately we have no control over. And that's what we have to remember. We have no control over any of those moving pieces. We just need to be flexible and make sure that we're adjusting. And we've already done so, right? If you're on this call and you're working with us, we've already done those different steps. But ultimately, just know that you have no control over that unrest. It's just things that we have to continue to keep top of mind when we're doing your long-term financial planning. So where are we now, right? So that's all of the stuff that's occurred, and I call it stuff. That's my PG rated word for all the stuff we're going through, right? So that's everything that we've been through to get to where we are right now, okay? And what I show up here are two different graphs, okay? On the left-hand side of the screen is the S&P 500 as of this morning. So it's probably fairly hard to see, but ultimately year to date, the S&P is down 21.07%. So from where we started at the beginning of the year to where we are right now, the S&P 500, which is the top 500 stocks in the United States, is ultimately down 21.07%. Most of the volatility that we've seen has happened or occurred in the second half of the year, right? And as I talked about before, right, as the economy started to dip, you could almost put a ruler to this. Gas prices were going up, 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 right? So what we saw is in the first quarter, the volatility that occurred, right, was anticipated based on the consumer price index going up. And then the Federal Reserve started to increase interest rates in March, and the markets actually reacted positively because they were anticipating inflation to start coming down. And then Russia invaded Ukraine, and the economy started to fall very quickly because gas prices started going through the roof. And that was an additional inflation that was hitting everybody's pocketbooks immediately. Ultimately, the market recovered nicely at the end of the second quarter into the beginning of the third quarter. And then we saw inflation continue to run rampant and higher and higher and higher. And the Federal Reserve has started to increase interest rates at an extremely rapid pace. Okay, so that's what's occurring with the markets now. We've had a nice few days in the markets this last week to get a little bit of a bounce. But ultimately, year to date, we're down 21% in the S&P 500 when we look at that. What's interesting is when we're taught, right, when you're in an economics course, let's say in college or wherever, traditionally, right, when things get really volatile, we're taught, oh, you're going to sell your stocks because they're volatile, and we want to be more secure. So we're going to buy bonds, right, fixed income. And when you do that, we're in a place that the interest rates have been historically low for the last 10 years. So what it's formed is this big bubble if you're in the wrong bond category, right? Not all bonds are created equal. So if my arm's a teeter-totter and interest rates go up, what do bond prices do, right? They fall. They work inverse of interest rates. Well, we've seen interest rates rise at a historically fast pace, which means bonds are falling at a historically fast pace, and it's something you have to pay attention to. So you can see the S&P 500 bond index, which is supposed to be a safety net for many investors, right, is down almost 17% year to date. So think about that. This is the safety net for the average investor, and it's down 17% where the market is down 21%. It's almost down the full amount of the market. So when I look at this and I sit with clients and I explain all this, they're like, that's interesting, right? That's the term they use, interesting. But what does that mean for me? And I'm going to show you a real life example here. Okay. So ultimately, a lot of clients, especially if they're still working or let's say getting close to retirement in their 401k, they're probably holding what they would call a target retirement fund. And all a target retirement fund is, and you can see this is the 2020 target retirement fund. What they're doing is the closer you get to retirement or the age that you pick, the year that you pick, right? So this is 2020. They're selling stocks and they're buying bonds. So what they're doing is they're making it more conservative the closer you get to your retirement age. Okay. In a traditional market, that's the key word. In a traditional market, it makes a lot of sense. But this is not a traditional market. So what we have to look at and pay attention to, this is the Vanguard Target Retirement 2020 Fund, right? So if we look through here, the first thing you have to do, and you guys can do this with your 401k, you go to morningstar.com or contact us. We do this all the time and walk through what makes sense, what doesn't. But you can see right here, interest rate sensitivity, moderate. That's a fancy term that just simply means as interest rates rise, these holdings will fall. So when we look at this and we look at the performance of this fund, and this is a 4-star fund, historically, this is a very good fund. You look at the cliffs that have occurred as interest rates have risen, and year to date, this is the safety net, right? Year to date, this holding's down 16%, right? You look at that and you say, well, the market's down 21, this is down 16, it still beat the market. That's true, but, right? And I'm going to explain what that but means. You can see inside this holding, approximately 60% is in fixed income, 40% is in stock. So what that means is this is taking about roughly 40% of the risk of the overall market, okay? Meaning that if you put a beta score to this, how much risk is it taking compared to the stock market? If you said the stock market was a 10, this is a 4 on that risk scale. So what that means is if the market's up, this holding should capture about 40% of the upside. Okay, so the stock market, the S&P 500 was up about 28% last year. This was up 8. So it held up almost perfectly, right? It was up about 40% of what the overall market was, actually underperformed slightly. But year to date, and this is what's occurring with the bubble, right? It should only be down approximately 40% of what the market is down. If the market's down 21, 40% of 21, this account should only be down approximately 7 to 8%. And you can see it's down double that because of the fixed income exposure, which means you're taking way too much risk to capture a portion of the upside. It's upside down. You should be capturing more upside and taking less risk. And that's what you need to make sure inside of those target-based holdings when you're looking at that. Okay. And I know I'm getting very specific, but I'm doing that because these are the things we have to pay attention to. And I just ask that you reach out to us and we'll look through that and ultimately dive through this to make sure you're not participating in as much downside and capturing more upside. All right. Let me go back to my screen share here. So transitioning here, just going ahead, looking ahead. Okay, so we've talked about inflation. We've talked about interest rates. We've talked about unrest in the world, right? We've talked about a strong dollar. We looked at the markets, and now we got to look ahead, right? And if you said, what do we anticipate looking ahead? You know, at some point, we will see inflation easing, right? We're already into this. We've already seen inflation start to come down. It was at 9.1% a few months ago. It's down to 8.3%. One of the key factors that we watch as well is in October, last October, inflation jumped by 0.9%. And that was with low interest rates. We've increased interest rates. So any gain this October, right, that's under 0.9 will continue to decrease that CPI report. So looking ahead, we are anticipating that inflation will start to ease and those CPI numbers are starting to become in check. That's a good thing. Right? The reason that that's good is long term, we'll start to see interest rates decrease, right? Meaning that they're not going to continue to increase interest rates at such a rapid pace. And it starts to get us to a point where we would call neutral, right? Where the Federal Reserve can either increase or start decreasing interest rates from that line. We're not there yet, but we're a lot closer now than we were even a month ago, 2 months ago, 3 months ago. Right? So we're starting to see those good economic factors come into play where inflation should start to ease and interest rates should also stop increasing at such a rapid pace. There's still a lot of uncertainty. There is absolutely still a lot of uncertainty that's out there. And what we have to do is basically plan for all of the what ifs, right? You start to put those measures in place and you insulate yourself from a lot of the garbage that's occurring out there by basically managing the things that we can control and making sure you're in the right sectors or you're protected. Which leads me into my final piece, which is just how to continue to be successful. And I know this is a lot of writing on here, so I'm going to put it into bullet point form for you. So, number one, and we're doing this. If you work with us, this is what we're doing already. Okay. This is a reminder. But number one, you have to continue to focus on companies and holdings that you have to buy the product regardless of what's occurring in the market and regardless of the cost. I always joke with my clients, toilet paper is a perfect example of this, right? If toilet paper goes up $1 a pack, you're still going to buy it, right? If something that you wanted to do, a non-essential, a non-necessity, they call those cyclical companies, increased, right? If airline stocks went through the roof, you're going to put off that trip, right? You're going to say, I don't need that, right? But ultimately, the essentials, your food, your beverage, your gas bills, right? Your energy, those are essentials that you need and what you focus on and do quite well. What we've actually found is that as inflation has increased, that has been the safe haven for many of our clients and been the safe haven for many investors all over the world because they're buying those staples because they pay a really nice dividend that help cover their distributions and ultimately position you to have a heck of a lot less volatility because they're essential. And if there's a price increase, they pass it along to us as the consumer, which stinks for us because we're the consumer, but ultimately as the investor, it allows the company to continue to maintain profit margins, right? You need to know what you're invested in and make sure that it's positioned properly to capture future growth. So for example, I used that 2020 fund, right? If the market was up 28% last year and that holding was up 8, right? And as long as you were willing to accept that return, it's fine, but you shouldn't be participating in almost all the downside. So what you need to do is if you're participating in that downside, you need to make sure that you're positioned in your account properly to participate in the upside as well, right? So we don't want you to take more risk on the downside and less upside. We want it opposite, right? You want that upside downside capture ratio to be in your favor and make sure that you're capturing all the upside that you deserve. Number 3 is we got to continue to focus on the long term. The media and the news does a horrific job of focusing or looking anything long term. It's all now and it's all gloom and doom. And I'm asking you to just continue to remove yourself from the now and know that things will get better and inflation will eventually go down and interest rates will be lower. And ultimately, we're in the greatest country in the world, right? So we need to continue to focus on that. Focus on the long term. If you're invested in a company that you trusted their product, liked their product, utilized their company services before the pandemic, before any of this stuff occurred, and you still use their product now, they're probably going to be bigger in the future than they are today, right? So just know that. Focus on the long term. This is an opportunity. Add to the accounts, right? I know. So Warren Buffett says it best, right? He has a phrase: be fearful when others are greedy, and be greedy when others are fearful. If you watch the news, everybody's scared right now, right? So when you hear that, this is the time, this is an opportunity to buy. I don't know if the market's going to go down another 5% before it goes up 25%. I don't have a crystal ball. But what we look at is the market's down 21% from where it was at its high. And long term, if you're a longer term investor, now's the time to start being more opportunistic and using that to your advantage. If you're adding to a 401k or adding to accounts, continue to dollar cost average. So keep adding to your contributions. We do seminars, which we'll invite you guys to, on how to dollar cost average properly, right? You have your current holdings in a 401k. That's your current assets. That can be more conservative, but you have your future contributions, right? That's money you haven't added yet. You can be more aggressive with future money because you haven't even put it into the account yet. You're buying all that at a discount. It'll be bigger gains in the future, right? So that's continue to dollar cost average and then insulate your income, right? We're really good at this. You guys as clients, you're really good at this, right? So you're focusing on dividends, dividend aristocrats. That's just a fancy term for a company that has increased a dividend for 25 consecutive years, right? You're looking for income protection. And then you need to identify, what are we taking income from now? And how do we do that without having to reduce principal or put a lot of strain on the portfolio? And then what is positioned for future growth, right? Because we cannot just be planning for the now. We need to plan for the now and position ourselves to make sure that you're successful, not only 10 years from now, 20 years from now, but ultimately multi-generational success in the future. So in a nutshell, we're going through a lot of stuff, but overall, the economy is very resilient. And as long as we're continuing to position ourselves, which we are, in the right areas where you have to have those products and positioning yourself for future growth, things will be significantly better in the future, and we will have some really good growth to be had. It's just ultimately, with interest rates increasing and inflation high, we are stuck in this sideways pattern, right? I'm going to open it up now to questions. Okay, so I've just talked for the last 37 minutes, right? So I'm going to open this up for questions on the bottom of your screen, or if you're on an iPad, it would be on the top of your screen. You can click either the Q&A button or the chat button, and you can type in a question. If there's something that is top of mind for you that you have a question with, I just ask that you type it over, because somebody else might have that same question. And we'll give it a couple minutes here for questions to come in. We'll answer some of these, and then we'll wrap this up.
Tyler, we have our first question on here. It says, are we in a recession? And if so, when did it start?
Great question. So I always call it the R word, right? If you watch the news, they say it like it's a swear word, right? So we've had multiple recessions throughout, the history of the United States. I mean, realistically, on average, we have a recession every 7 years. You only know of a handful of them, right? So you think of like 2001, 2002, 2007, 2008, the flash crash back in the 80s. Those are the big ones that stick with you. So typically, a recession is defined by 2 negative quarters of GDP growth. So that would be an indication of a recession. The problem with that indicator is you don't know if you're in a recession until you're actually through those 2 quarters, right? So that means you've already been in a recession leading up to that second quarter of negative GDP growth. Now, what they've done is the administration came out and changed that verbiage a bit. And they said you also need unemployment to be increasing. Well, we're in a different time right now. We're in a labor shortage. So it's a different field that you have to look at. You could actually see unemployment stay low and have 2 negative quarters of GDP growth, because we made everything more expensive to combat the inflation, because we infused so much cash flow into the economy. So right now, based on the scale that the administration is putting out there, they are not calling what we're in a recession. They're calling it a strategic slowdown to try and curb inflation. But even if we are, don't be scared of that word, right? I mean, don't be scared of being in a recession, because you're going to be positioned in those companies for long-term growth, where you still have to have that product, and they're good, solid companies, and they'll come out of it. It's just ultimately the market is typically pricing in a slowdown 6 months in advance of something occurring. And we've already started to see that pricing in, already a quarter ago. And that's some of the volatility that we're seeing. That's a really good question.
There's another question that just came in based off of your explanation, which was, why did the government change the definition of the recession?
That's a great question. So, I'm not on that panel. I'm not on that committee. We're in a different time where ultimately the government is trying to slow down the economy to hedge inflation. And what I mean by that is they're making interest rate go higher, credit go higher to reduce spending a bit. So I don't think that they want to call it a recession, because they're being strategic about it, right? So they're not, corporate earnings are down, but they're not down anywhere near what we have seen historically, right? I was looking at a slide earlier, just in preparation of this presentation. In 2007, 2008, corporate earnings dropped by about 77%, right? Right now, we're seeing an average corporate earning drop by about 7.9%. So it's 1/10 of the drop, right? It's something where if you look at companies now compared to where we were in 07, 08, they're different animals, right? Technology has taken over and profit margins for a lot of these companies are very high and they're able to weather that as long as inflation decreases. So I don't think they want to call it a recession because they're saying, hey, people are still healthy and spending, but a lot of what we're seeing from a decrease of spending is coming because we're increasing interest rates. So that would be my assumption, but I'm also not going to overstep my bound there because I'm not on that committee and I don't define it.
Okay. I have another question that came in that says, why does 2/3 of the money go to the Federal Reserve?
So with quantitative easing, that's where that question came from. That just means that they were listening. So thank you for listening. So quantitative easing, when they're doing is they're propping up the economy and they're purchasing either treasuries or they're purchasing assets such as ETFs and so forth. So by doing that, they're creating a supply and demand. So it's the same thing within the market. They're purchasing those assets. And as they purchase those assets, that means there's more buyers. So the assets can start to increase or it gives it stability in the market, right? So ultimately, what they're doing is they have to hold that money on reserve because they purchased the asset, and the Federal Reserve can use that then as ammunition later on. With stimulus money, what they're doing is they're giving the money directly to the consumer, and the consumer can use that money and spend it. And as they spend it, the demand to buy things goes up because you have more cash flow. And that's what's creating the inflation right now. So that's what's different between quantitative easing and the stimulus. The stimulus is going directly to the end user, which is us. And the quantitative easing piece goes more to the Federal Reserve to use as ammunition to help prop up markets when necessary.
Awesome. Thank you so much for asking or answering that, Tyler. I have another question that came in that says, I am retired and near needing to withdraw retirement funds. Should I wait until the market value increases?
Okay, can you do it one more time for me, Jenna, please?
Absolutely. I am retired and near needing to withdraw retirement funds. Should I wait until the market value increases?
So what you want to do anytime you're retired, if you need distributions, you always want to look at where you're going to draw your income from regardless, right? So you want to position your assets in a perfect world. You position your assets in a way that you would look at how much you're going to spend per month. And let's say that number is, I'm going to make up some numbers here, is $5,000 a month. And then you look at what guaranteed income sources you have coming in. So if your Social Security, let's say, is $2,000 a month, that means you have a need of $3,000 per month. And maybe you have a pension for another 1,000. So we have a shortfall of $2,000 a month that we need to fill from investments. What we would do is we would typically set that in what we call our income bucket. You would have something that's generating some form of protected income stream, whether it's a dividend aristocrat or something like that, that is kicking off a dividend where you don't have to touch your principal and ultimately allows you to not have to worry about depleting your assets during a time like this, right? You live off that dividend. You still own all your shares as the market goes back up. You continue to see your gains. If you're not in a position, some people aren't in a position for that, or they might have held, let's say, just say some mutual funds or something that doesn't have that dividend that they can prepare for. What you're looking at then is setting aside some assets for near-term income. So let's say that you had in your portfolio, you had a portion that was invested for the long term, a portion that was invested maybe in some dividends, but you still needed some income. If you absolutely needed the income, you would take it from the most conservative bucket because it had the smallest decrease in value. So if you were holding something that was only down 2%, that means that you have more purchasing power in those shares because it went down by such a small amount. You do not want to sell something that's at a 20 or a 25% discount because you're literally selling 2 or 3 times the amount you would have sold a year ago. So don't touch it if you don't need it. If you do need money, absolutely, then you would touch some of the more risk-adverse assets that you hold in the short term to bridge that gap.
That was a great, thank you. Thank you, Tyler. I have another question. I got one email and then I have another question as well. It says, I'm going to retire in 12 years. There will be plenty of time for things to change. Awesome observation. Should someone in my position just keep plugging away an out of sight, out of mind approach? That's a great question.
It's a great question. Yes and no. Yes and no. So out of sight, out of mind works as long as you're in the right holdings. So I'll give you an example. I had a client who took this approach. They changed careers, changed jobs, did out of sight, out of mind, and then checked it 5 years later when they came to me. It was the first time I ever met them. And we looked at their report and they said, I don't ever pay attention to this. I just put it in and away it goes. And they were putting for 5 years their contribution directly into cash in their 401k because it was out of sight, out of mind. So that is an example that that's the wrong investment because they missed a 5-year window of growth and continued, dollar cost averaging. So as long as you're utilizing everything you should. So if you're saying, hey, I've got a window of 10 to 12 years before I'm going to retire, ultimately what you're doing is you're saying, what goals and time horizons do I have that I want to achieve? So you want to make sure that you're putting number one into the right buckets for tax efficiency. So Roth 401k versus traditional 401k, getting that taken care of, then putting into a Roth IRA or after tax accounts outside of that. And you want a dollar cost average into those, but it needs to be the right holdings. And each year you need to just take a look to make sure it still is the right investments. But the systems and the approach that you use, that's what should be set and forget. So not the investments that you're utilizing, but how you approach saving, that should be set and forget. You should always max out your 401k if you can, or put into your Roth if you can. But what you're doing is designing what you want your retirement number to be. And then we know how much you need to save each month to get there. That's what you set and forget. And then the investments you continue to check on to make sure that they're the right investments for what your risk profile is, et cetera.
Awesome. That's a great question. I have someone who actually emailed me to ask a question about the oil prices and inflation. So what about the oil prices rising again, and how will that impact the inflation and the market coming here soon?
Yeah. So, gas prices are a wild card anywhere, right? So gas is an immediate inflation increase on the average consumer. So I use this example with clients all the time. So let's say that you go to the grocery store once every 2 weeks, right? And I know you probably go there more than that. I know my wife does, but let's say you do your main grocery shopping once every 2 weeks. And when you buy your groceries, let's say that it costs, $50 more than it did, a year ago at this time. So if you go twice a month to the grocery store, right, once every 2 weeks, and it costs $50 more each time, that's $100 more that it costs you just to buy groceries. But what you have is you have a 2-week reprieve, right, in between where you're not impacted or hit with that inflationary increase at the grocery store because you're only going every 2 weeks. So that's a calming nature to the average consumer. That's number one. Number two, what you run into when you go to the grocery store is if you really like this bag of chips, but this bag of chip costs $5 a bag, and that bag over there is an off-brand and it costs $3 a bag, you start to change your consumer habits and you're going to buy the off-brand because it's cheaper, right? With gas, you don't have that option. You go to the pump, you have to get unleaded gas or premium unleaded gas. And it's not like you can go to another gas station and it's considerably cheaper and going to save you a bunch of money. So you have no option. The problem with gas and inflation is it's immediate. So if you're married, and let's say you have some kids and you're driving 3 vehicles per week, you're probably filling up once a week. Your wife's probably filling up once a week, and your child might be filling up once a week. Well, that's 3 gas tanks. And if it costs $25 more per gas tank, that's $75 a week. Take that times 4. That's $300 a month of extra spending that you had on gas, and you're getting nothing in return other than your normal, driving habits for a vehicle. So what gas prices being elevated does is it starts to change consumer habits. So ultimately, it'll get to a point, and we were starting to see it when gas prices were over $6 a gallon here in Illinois, right, where people are driving less. They're deciding to do things differently than they did before, and it changes the scope of what the outlook is for certain sectors. And that's the key word, certain sectors in the market. Because there's also other sectors that do quite well when gas prices rise. So, if gas prices get elevated, right, that's something that we have to continue to pay attention to because, yes, the overall expenses of the CPI, the Consumer Price Report, will go down. But if gas shoots through the roof, right? That could lead some of that back up. And interest rates typically don't have near the bearing on gas that they would on other products. That was a really long-winded response. I'm sorry.
That's perfect. We love it. It's great. It's great knowledge. So the next thing that just came in, and I probably think this will be the last question we answer because we are nearing an hour here, is why is the increasing interest rate affecting the groceries? We knew the supply chain was interrupted in the summer of 2020 or 2021. I understand increasing interest rates affect large purchases like housing or car purchases.
Yeah. So increasing interest rates doesn't impact groceries, right? Inflation impacts the groceries, right? Increasing interest rates is a tool to reduce inflation. So interest rates going up will not make your groceries more expensive. What it does is it makes the interest that a credit card or a company like that charges you on a purchase more expensive. So when interest rates go higher, what they're doing is they're trying to make things more expensive, right? And it's more your big ticket items. It's items that you're purchasing on credit, right? They're making credit more expensive. So if you're purchasing a house and your interest rate on your mortgage was 3%, now it's 7%, that's more expensive, right? You can afford less house for the same payment. So groceries are being impacted by supply and demand and inflation. So the interest rate is really the tool that's going up to try and actually make groceries less expensive for you. But what it's doing is it's making anything that you buy on credit more expensive than it was a year ago. So that's where the interest rate piece comes in.
Okay, awesome. I believe that we are done. I did get a couple more questions. So I want you guys to be aware, if you guys do have questions, please feel free to reach out to us, 847-680-9050. I do see 3 unanswered questions on the screen right now, and I do have an email in here. Please know that we will reach out to you very shortly within the next couple of days to answer these questions. But for the sake of time and for Tyler's expertise and knowledge, we do appreciate this.
Yeah.
Final words to her?
Yeah, I really appreciate all of you taking the time and the continued faith and trust. And we're working our tails off over here during these volatile times. And quite honestly, you're doing very, very well. And the best thing we can do is just continue to manage emotions during times of uncertainty, which all of you are doing very well with, and ultimately continue to position ourselves in the right place to continue to take advantage of future growth as it comes. So ultimately, if you do have specific questions, even outside of the 3 that Jenna mentioned, shoot us an email, give us a call. We absolutely will get back in touch and get those answered for you, or even sit down. If you have more specific questions, dealing with your portfolio or just questions that are out there, reach out to us. We can set up a time as well, and we're happy to do so. So I appreciate all of you taking the time to listen to this.